There is a quiet revolution happening in America, and almost nobody is talking about it. Not because the information is hidden behind a paywall, not because you need a finance degree to understand it, and certainly not because the strategy requires some rare, once in a generation stroke of luck. The revolution is being missed because the people participating in it look from the outside like they are doing absolutely nothing. And in a world addicted to hustle culture, cryptocurrency drama, and the dopamine rush of watching a stock ticker move in real time, doing nothing is the most radical act you can commit with your money. So let us talk about the most misunderstood wealth building mission in this country, turning $5,000 into $100,000. Not through some breathless trading strategy, not through leveraged options contracts you barely understand. Not because some faceless stranger on social media pointed at a chart with red arrows and a caption that said, "This is your last chance." We are going to talk about the boring path, the quiet path, the embarrassingly, almost offensively simple path that has been sitting in plain sight for decades, while most Americans walked right past it on their way to something flashier that ultimately cost them everything. And before you check out, let us be honest about something. When most people hear $5,000, they do not feel inspired. They feel underwhelmed. For some people, $5,000 is a tax refund that evaporates into a vacation and a new television before April is over. For others, it is a work bonus that pays down a credit card and then somehow disappears anyway. For a lot of people, $5,000 is the exact amount sitting in a checking account right now. Not invested, not working, not growing, just sitting there, collecting the emotional comfort of feeling available. And that is exactly the problem. Not the amount, the mindset attached to it. Because $5,000 is not powerful because of what it is the moment you look at it. It is powerful because of what it becomes if you stop treating it like spending money in disguise and start treating it like a tiny, tireless employee who asks for nothing, never calls in sick, never demands a raise, and never takes a vacation day. An employee who, given the right environment and enough time, quietly compounds your future while you are busy living your life. The transformation is not about the number. It is about the decision to deploy it correctly and then, crucially, to leave it alone. Let me show you exactly what the wrong decision and the right decision look like side by side, using two completely ordinary people living completely ordinary lives. Meet Marcus. Marcus is 30 years old, works a standard 9 to 5, earns a comfortable middle class income, and receives a $5,000 bonus from his employer in March. Marcus is not irresponsible. He's not foolish. He's just busy, slightly overwhelmed by the financial landscape, and genuinely uncertain where to begin. So he does what millions of Americans do in that moment of uncertainty. He keeps the money in his checking account. He tells himself he will invest it when things settle down, when he knows a little more, when the market feels less unpredictable. Those conditions, of course, never quite arrive. And over the next decade, that $5,000 does not disappear all at once in some dramatic financial collapse. It disappears slowly, invisibly, in the most anticlimactic way possible. A car repair here, a few months of elevated grocery bills there, an online shopping cart that filled itself during a moment of late night emotional vulnerability. Inflation quietly eroding its purchasing power every single year. 10 years later, Marcus is 40. The money is gone, and he has nothing to show for it except the vague, uncomfortable feeling that time has somehow slipped away from him. Now meet Rachel. Rachel is also 30 years old. Same type of income, same busy, distracted life, same $5,000 sitting in front of her. But Rachel does something so straightforward, so decidedly unsexy, that it almost sounds like she is not trying. She opens a Roth IRA, purchases a broad, low-cost index fund that tracks the total US stock market, turns on automatic dividend reinvestment, and then does something that most people cannot bring themselves to do with money they care about. She does nothing. No daily account checks, no panicked selling when the market dips, no switching strategies based on whatever financial personality just went viral. Just disciplined, structured, automated, nothing. If Rachel's $5,000 grows at approximately 8% annually, not a guarantee, but a historically reasonable long-term approximation for broad stock market exposure, that single initial deposit can grow to over $100,000 in roughly 39 years without Rachel contributing one additional dollar. And yes, somebody in the comments is already formulating a response right now. 39 years is an eternity. I will be nearly 70. And that is a fair point, one worth addressing directly and completely, because that reaction is exactly what keeps most people stuck. The 39-year timeline assumes Rachel invests once and vanishes permanently from the equation. No additional contributions, no raises deployed intelligently, no automation quietly working in the background. Just a single seed dropped into the ground and completely abandoned. And even under those bare minimum conditions, $5,000 becomes $100,000. But the lazy path, the real lazy path, is not a single deposit. It is a system, a structure designed so that the rules, the tax code, the automation, and the compounding mathematics are all deliberately tilted in your favor, working together like a well-oiled machine that runs whether you are watching it or not. And the first, most critical thing to understand about that system is something that most Americans almost entirely overlook in favor of a far more glamorous, but ultimately less impactful conversation. It is not what you invest in. It is where you invest it. Most people spend enormous mental energy debating individual stocks, chasing sectors, trying to identify the next great company before the crowd discovers it. Meanwhile, they are doing all of that inside completely unoptimized accounts that quietly hand a significant portion of their gains directly to the IRS every single year. It is like debating which premium organic groceries to buy while the refrigerator is unplugged. The food itself becomes irrelevant. The container is what determines whether it keeps or spoils. And most Americans are investing in unplugged refrigerators while obsessing over the groceries. The first container every working American should understand, and understand deeply, is the Roth IRA. Now, this is not a blanket prescription for every person in every financial situation, because income levels, tax brackets, and personal circumstances create real differences in which account type makes the most sense. But the conceptual power of the Roth IRA deserves to be spoken about with the kind of reverence most people reserve for complicated investment strategies that require monthly subscriptions to understand. The structure is elegantly simple. You contribute money you have already paid income tax on. That money is then invested and allowed to grow inside the account. And if you follow the rules, the growth, all of it, potentially decades of compounding, can come out completely tax-free in retirement. Let that land properly. If Rachel's $5,000 becomes $100,000, the remarkable part is not just that she earned $95,000 in profit from a single deposit. The remarkable part is that she may never owe the IRS a single dollar on that growth. That $95,000 does not get shared. It does not get reduced by a tax bill that arrives at the worst possible moment. It is hers, entirely, quietly, boringly. For the 2026 tax year, the IRA contribution limit sits at $7,000 for individuals under the age of 50, with a higher catch-up allowance for those 50 and older. So Rachel's initial $5,000 deposit fits comfortably inside a single year's allowable contribution for most eligible earners. And this is where the majority of people lose the game before they even step onto the field. They hear Roth IRA, and their mind immediately jumps to a question they are not yet equipped to answer. Which stock do I buy? But that question, well-intentioned as it is, completely misses the actual lazy genius of the approach. Because the real lazy move is not identifying which individual company will outperform the market over the next decade. Statistically, even professional fund managers with armies of analysts and decades of experience fail to consistently outperform a simple index fund over long time horizons. The real lazy move is to own the entire competition simultaneously. A total US stock market index fund or an S&P 500 index fund means you own small pieces of hundreds or thousands of American companies at once. You do not need to predict which company wins the next decade. You just need to own the entire scoreboard and collect the results of American economic growth as a category, not as a bet on any single player. But here is where Rachel's $5,000 to $100,000 journey can be dramatically, almost shockingly accelerated. Because the difference between waiting 39 years and waiting 17 years comes down to one number: $200 a month. If Rachel invests her initial $5,000 and then adds just $200 every single month at that same 8% annual return assumption, the timeline to $100,000 compresses from nearly 4 decades to approximately 17 years. She would cross the six-figure mark before she turns 47. And if she manages $300 per month in contributions, that window shrinks further to roughly 15 years. The mathematics of consistent contribution combined with compounding growth is not subtle. It is staggering in its cumulative effect. Now, I am not going to stand here and tell you $200 a month is trivial, because for a meaningful portion of the people reading this, it genuinely is not. But I am also going to be honest about what $200 a month actually represents in most people's financial lives, because the conversation around "I can't afford to invest" deserves a more honest examination than it usually gets. $200 a month is the delta between one streaming service and four. It is one fewer restaurant dinner per week than the average American household currently spends. It is the difference between buying a car with a $400 monthly payment and buying one with a $200 monthly payment. It is often one low-grade online impulse purchase habit, one subscription that auto-renews every month without providing meaningful value, one fewer order from whatever app delivers dinner in under 3 minutes. It is not billionaire money. It is choices money. Here is the psychological secret that changes everything about how you make those choices sustainably. You do not try to become an investor every single month by making a conscious, willpower-dependent decision to transfer money into your account. You become an investor exactly once, on the day you set up automatic contributions from your paycheck or bank account. After that, the decision has already been made. The automation executes it on a schedule, without consulting your mood, your stress level, your desire for emotional retail therapy, or the fact that a new product just launched that you are somehow convinced you need immediately. Your mood is terrible with money. Every mood is terrible with money. Moods want instant gratification. Automation wants net worth. In a direct competition between those two forces, you want to make absolutely certain that automation wins before the mood even gets a vote. The second lazy wealth building tool that most working Americans are actively failing to take full advantage of is so fundamentally straightforward that its widespread neglect is one of the more quietly devastating financial phenomena in this country: the employer 401k match. If your employer tells you, in clear and simple language, contribute a portion of your salary to your retirement account, and we will contribute additional money on your behalf, what you are being offered is not a benefit. It is deferred compensation that you only receive if you fill out a form. It is part of your total compensation package that sits unclaimed in your employer's budget every single pay period that you fail to contribute enough to trigger the full match. And tens of millions of American workers either contribute nothing, contribute less than the match threshold, or delay starting because retirement feels abstract and far away, and there are more immediate things demanding their financial attention. If your employer matches 50 cents for every dollar you contribute, up to 6% of your salary, and you earn $60,000 per year, you are leaving $1,800 in guaranteed pre-market return compensation sitting on the table every year you fail to capture it. The stock market could deliver flat returns for an entire year, and that match still handed you an instant 50% return on the dollars that triggered it. There is no investment product in the legal, conventional financial marketplace that can promise you that kind of immediate return. It does not exist. And yet the 401k match sits there, available, documented in your employee benefits packet, and routinely unclaimed. For 2026, the employee contribution limit for 401k style plans stands at $23,500 for individuals under 50, with a higher catch-up contribution limit available for those 50 and older. You do not need to hit that ceiling to make the strategy work. The first, most critical objective is simply contributing enough to capture every dollar of match your employer offers. Everything beyond that is optimization. But the match itself is the floor, and failing to reach that floor is one of the most expensive financial decisions a working American can make, precisely because it does not feel like a decision at all. It just feels like inertia. And this is one of those quiet, unspoken class divides that nobody teaches in school. Two people can work at the exact same company, earn the identical salary, and sit 3 desks apart from each other. One of them hears retirement account and thinks it is something for people who have extra money lying around after the bills are paid. The other hears retirement account and immediately asks, where is the free money? What is the tax advantage? And what is the minimum contribution required to capture the full employer match? Same job, same paycheck, completely different relationship with the rulebook. And over a 30-year career, that difference in financial fluency can translate into hundreds of thousands of dollars in accumulated wealth. Not from superior intelligence, not from a higher income, but simply from knowing the rules of a game that everyone is involuntarily playing. The third lazy tool is one that, if you discovered it for the first time today, you might briefly wonder whether there had been some administrative oversight in the tax code. Something that feels less like a financial product and more like a cheat code that was somehow left in the game by accident. It is the health savings account, more commonly known as the HSA, and it carries what is, without exaggeration, the most powerful tax structure available to any individual investor in the American financial system. The HSA is only accessible if you are enrolled in a qualifying high-deductible health plan, so this tool does not apply universally. But for those who do qualify, the account operates on what the financial world calls triple tax advantagement, and that phrase alone deserves a moment of serious attention because it is unlike anything else available to ordinary individual investors. First, money you contribute to an HSA goes in either pre-tax through payroll or tax-deductible if you contribute directly. Second, that money grows inside the account completely free of taxes. Third, when you withdraw the money to pay for qualified medical expenses, those withdrawals come out tax-free as well. 3 separate tax advantages in a single account. No income tax on the way in, no capital gains tax while it grows, no income tax on qualified withdrawals. For comparison, a traditional 401k gives you a tax break going in and then taxes you on the way out. A Roth IRA taxes you going in and lets you withdraw tax-free later. The HSA, used correctly, does both simultaneously, which is why financial planners who understand it tend to discuss it in slightly reverent tones. For 2026, the HSA contribution limits are $4,300 for individuals with self-only coverage and $8,550 for those with family coverage, with an additional catch-up contribution available for individuals aged 55 and older. Here is the version of HSA usage that most people never discover, because the common understanding of the account treats it purely as a medical checking account. Money in, pharmacy receipt, money out, repeat annually until the balance is perpetually zero. That approach captures 1/3 of the account's potential. The lazy wealth building version operates entirely differently. You can manage to pay smaller day-to-day medical expenses directly from your regular cash flow rather than from the HSA. You can instead invest the HSA balance in low-cost index funds. Yes, many HSA providers offer investment options within the account and allow that money to compound tax-free over years or even decades. Meanwhile, you save every single qualifying medical receipt from every year you leave the money invested. Because the IRS places no time limit on HSA reimbursements for qualified expenses. You can reimburse yourself for a medical expense that occurred 5, 10, or 15 years ago, as long as the expense happened after you opened the account and you have the documentation to support it. Which means the HSA, deployed in its most sophisticated form, functions as an additional tax-advantaged retirement account that you can eventually tap through a growing collection of old receipts, while the underlying balance has had years to compound without taxation at any stage. Nobody is going viral with a video titled, "I organized a folder of medical receipts for a decade and optimized my tax-advantaged accounts." But quiet wealth is almost always constructed from decisions that look dull on social media and extraordinary on a balance sheet 20 years later. The fourth lazy tool is not a wealth generation vehicle in the traditional sense, but it is foundational in a way that makes all the other tools viable. Because the most sophisticated investment strategy on earth is completely useless if you are forced to liquidate it at the worst possible time due to a financial emergency that a proper cash reserve would have absorbed effortlessly. This is the role of treasury bills, high-yield savings accounts, money market funds, and Series I savings bonds. They are the protective infrastructure for the money that is not meant to grow aggressively. They are the stable foundation that allows the aggressive, long-term growth strategy to actually run its full course without interruption. The most common and financially devastating mistake in this category is binary thinking. People either keep everything in cash because it feels safe, or they feel pressure to put everything in the market because that is where growth happens. The correct structure is not either or. It is layered. Short-term money, your emergency fund, your car repair buffer, your "the furnace died in February" fund, belongs in stable, liquid, accessible accounts. A high-yield savings account earning something meaningful, a money market fund, short-term treasury bills. This money's job is not to multiply. Its job is to be there, immediately, without requiring you to sell an investment at a loss to access it. Long-term money, money with a 5, 10, 20, or 30-year runway, belongs in growth assets because it has the time to absorb volatility, recover from downturns, and participate in the compounding that builds serious wealth over decades. And within the safe money category, Series I savings bonds represent one of the more consistently underappreciated options available to ordinary American savers. These are U.S. government-backed savings bonds specifically designed to provide returns that keep pace with inflation. For I bonds issued between May 1st, 2026 and October 31st, 2026, the composite rate stands at 4.28%, including a fixed rate component of 1.00%. There is a 1-year minimum holding period and a 3-month interest penalty for redemptions made before the 5-year mark. So they are not a vehicle for money you might need next Tuesday. But for cash sitting in an emergency fund that you genuinely hope never to touch, I bonds offer inflation protection from the U.S. Treasury itself, backed by the full faith and credit of the federal government. The deeper principle at work here is a reframe that wealthy people apply automatically, and most people never learn to apply at all. Wealthy people do not ask, "Where should I put my money?" They ask, "What job does this dollar have?" If the job is to be available immediately when something breaks, it needs a stable, liquid home. If the job is to become $100,000 over 17 years, it needs a growth-oriented, tax-advantaged account and enough time to do the work. If the job is to cover healthcare costs tax efficiently across decades, perhaps the HSA is the optimal container. If the job is retirement, perhaps the Roth IRA or 401k is the right workplace. The money is the employee. The account is the position you hire it into. Put a long term growth employee in a no interest checking account, and you have wasted decades of productivity. Put an emergency fund employee in a volatile stock portfolio, and you have created a situation where the next crisis forces you to sell at exactly the wrong moment. Now, let us talk about something that lives in the fine print of almost every investment conversation. Gets mentioned briefly and then gets immediately forgotten in favor of something more exciting: fees. Investment fees are the most socially acceptable form of wealth extraction in existence, precisely because they are expressed as small, calm, almost apologetic percentages that sound completely harmless on first hearing. 1%. That sounds like nothing, less than nothing. It sounds like a rounding error. It sounds like the kind of number you would not even bother negotiating. But a 1% annual management fee applied to a growing investment account over 30 or 40 years does not cost you 1%. It costs you a compounding drag that, over those timelines, can consume tens of thousands, sometimes hundreds of thousands of dollars from the final account balance. Every percentage point of annual fees that you pay is a percentage point of compounding that happens inside someone else's bank account instead of yours. The difference in final account values between a low-cost index fund with an expense ratio of 0.03% and an actively managed fund charging 1.00% on the same underlying market performance is not a subtle, barely measurable distinction. Over 30 years, on a starting balance of $5,000 with consistent monthly contributions, it can represent a gap of tens of thousands of dollars. That is not a brochure line item. That is a car. That is a year of college tuition. That is the difference between the version of retirement you planned and the version you have to accept. This is why lazy investing is not synonymous with careless investing. They are fundamentally different postures. Lazy investing means you have deliberately removed unnecessary complexity, unnecessary trading, unnecessary fees, and unnecessary emotional decision making from the equation. You have chosen broad diversification across thousands of companies, which eliminates single stock risk. You have chosen low cost vehicles, which keeps the compounding inside your account rather than bleeding it out to fund managers. You have chosen tax-advantaged accounts, which keeps the growth away from the IRS for as long as possible, or permanently. You have chosen automation, which removes your mood from the equation entirely. And you have chosen a long time horizon, which is the single most powerful variable in the entire wealth building equation, because time is the input that makes every other element of the system more powerful. Careless investing, by contrast, is not investing at all. It is financial entertainment with real money. It is rotating your portfolio based on what a comment section believes this week. It is buying a stock 3 weeks after it has already tripled because the momentum made it feel inevitable. It is mistaking confidence for research and excitement for analysis. And the two are routinely confused because both involve financial accounts and the emotion of anticipation. The difference is that one is building a future, and the other is consuming one. And this brings us to the most honest, uncomfortable, and ultimately most useful part of this entire conversation. The reason most Americans never bridge the gap between $5,000 and $100,000 is not lack of tools, lack of information, or lack of opportunity. The reason is interruption. They interrupt the process. They invest, and they stop when the market gets volatile. They buy when social consensus says things are going up, and they sell when fear says things are going down, which means they systematically buy high and sell low. the literal opposite of every rational wealth building strategy ever articulated. They change their entire investment philosophy every 6 months based on what financial content is currently performing well on the internet. They treat their long term portfolio like a group conversation, where every new voice gets a vote, including the loudest, most confident, and most demonstrably wrong voices in the room.
But compounding is not a cooperative process that accommodates constant interference. It is a mathematical phenomenon that requires time and continuity to reach its full potential. Every time you interrupt it, every time you sell during a downturn, every time you redirect the money towards something else, every time you restart the clock, you are not just pausing the growth, you are resetting the exponent. And the difference between leaving $5,000 alone for 39 years and restarting it 3 times across 39 years is not arithmetic. It is catastrophic. If Rachel invests her $5,000 and the market drops 25% the following year, her account shows roughly $3,750 on paper. That looks like a loss of $1,250. It feels like a failure. It feels like the beginning of a collapse. And if her instinct is to sell and stop the bleeding, she transforms a temporary paper loss into a permanent, realized, irreversible one. But if she stays invested, and if she is young enough to have years ahead of her, that same market downturn means that every future contribution buys more shares at lower prices. The very thing that looks like damage is actually an accelerant for anyone with the discipline to keep contributing. The wealthy understand market volatility as the admission price for long-term returns. It is not a flaw in the system. It is a built-in feature, an emotional filter that separates people who get to participate in long-term compounding from people who perpetually restart, perpetually react, and perpetually underperform. The market's capacity to be frightening in the short term is precisely what creates the return opportunity in the long term. Because if it were smooth and predictable and emotionally comfortable, every dollar on earth would rush toward it, and the returns would disappear. So here is what the full lazy system looks like, assembled into a clear, sequential, actionable structure. Before you invest the first dollar, ensure you have a functional emergency buffer. Not a perfect, fully stocked 3 to 6 month reserve necessarily, but enough that an unexpected $800 expense does not force you to sell investments at an inopportune time. Because investing money you might actually need in the next 3 months is not investing. It is a liquidity trap disguised as a wealth building strategy.
Then, if your employer offers a matching contribution to a 401k or similar workplace retirement plan, make capturing that full match your first investment priority. Full stop. Before anything else. The match is the only financial opportunity in existence that offers an immediate, guaranteed, before the market even opens return on your contribution. Ignoring it is not conservatism. It is one of the most expensive, passive financial decisions a working American can make. Then, if you are eligible based on income and plan type, fund a Roth IRA or a traditional IRA, depending on whether your current tax bracket or your anticipated retirement tax bracket is higher. A distinction worth understanding even at a basic level before making the choice. Inside that IRA, invest in a low-cost, broadly diversified index fund. Or if you want the simplest possible version that requires zero ongoing decisions, a target date fund aligned with your approximate retirement year. Then automate a monthly contribution. Whatever amount is genuinely sustainable given your actual current budget, even if it is smaller than you would like. A $75 monthly contribution that continues uninterrupted for a decade is infinitely more powerful than a $500 contribution made twice and then abandoned because the discipline required to sustain it was never properly established. Then, every single time your income increases, a raise, a promotion, a better paying position, resist the seductive, deeply American gravitational pull of lifestyle inflation and redirect a meaningful portion of that increase directly into your investment contributions. before your spending habits have the opportunity to adapt to the higher income and eliminate the surplus entirely. Then leave it alone. Tend to the system during annual reviews. Rebalance if needed. Increase contributions as income grows. But do not check the balance every morning like it is a living thing that needs supervision. The account does not need your attention. It needs your patience. That last instruction, leave it alone, is the hardest one for most people to follow, which is why it deserves to be stated with complete clarity. In personal finance, setting up an optimized system and then deliberately stepping away from it is not laziness. It is discipline disguised as inactivity. It is the highest leverage move available to any long-term investor who does not have access to insider information and does not intend to compete professionally with institutional traders. It is the move that historically and statistically has outperformed most of the active, engaged, constantly optimized approaches that feel like they should do better and almost never do. Let the numbers make the point with total clarity. $5,000 invested once at 8% annual growth for 39 years, approximately $100,000. No further contributions required, just time and the discipline not to interrupt it. $5,000 plus $100 per month at the same rate of return crosses the $100,000 threshold in approximately 23 years. $5,000 plus $200 per month, approximately 17 years. $5,000 plus $300 per month, approximately 15 years. $5,000 plus $500 per month, you are potentially looking at a 12-year timeline, crossing six figures before many people have finished debating whether the market is a good time to start. None of these projections are a promise. Markets do not move in steady, predictable 8% annual increments. Some years the market will deliver 24%. Some years it will deliver negative 18%. Some years will feel like confirmation that the entire financial system is a construct designed to extract money from ordinary people. Most years will be somewhere in the emotionally confusing middle. What matters is not any single year's performance. What matters is the cumulative direction across time and the iron commitment to not interrupt the compounding by reacting to the short-term noise. And the calculus changes meaningfully based on when you start, which is worth stating plainly because the difference is not subtle. A 25-year-old who starts today does not need to be financially sophisticated. She needs time, a modest monthly contribution, and the emotional resilience to leave the account alone through multiple market cycles across multiple decades. She does not need genius. She has a resource that cannot be manufactured, borrowed, or purchased at any price. 4 decades of compounding runway. A 45-year-old who starts today is not out of the game, but the mathematical reality is that she needs larger contributions, a higher savings rate, and significantly less tolerance for financial distraction and poor decisions. The runway is shorter. The compounding has less time to do the heavy lifting. The margin for error has contracted. But the option to build serious wealth through consistent, disciplined, properly structured investing remains real and available. 60-year-old looking at this landscape is not in a hopeless position. But the luxury of waiting for more information, waiting for better market conditions, waiting for a clearer sense of what the right move is, has essentially expired. Every additional year of delay at that stage is not a neutral decision. It is an expensive one, measured in lost compounding and compressed options. The best time to build this system was the day you received your first paycheck with a meaningful amount left over after essential expenses. The second best time is not after you have consumed 12 more hours of financial content looking for a version of this information that feels more exciting. It is now, after reading this, with whatever imperfect, incomplete, smaller than ideal amount you currently have available to start. And please receive this next part with the seriousness it deserves. Nothing in this conversation constitutes personalized financial advice for your specific life circumstances. Debt levels, interest rates, income stability, family obligations, health status, tax situations, and risk tolerance all create meaningful individual variation in what the optimal sequence of financial decisions looks like. If you are carrying high interest credit card debt at 22% to 27% annual interest, paying that debt down may represent the single best guaranteed return available to you at this moment, because eliminating a 25% interest charge is mathematically identical to earning a 25% guaranteed return, which no legitimate investment can promise. If your emergency fund is genuinely non existent, deploying every available dollar into growth investments can create a situation where the next unavoidable expense forces a sale at the worst possible time. If your employer offers a match and you are not capturing it, that is the most immediate and addressable financial inefficiency in your life right now. The sequence matters, not because there is only one correct path, but because the wrong order can create cascading problems that undermine the entire structure. Most people were never taught the order of operations. They were taught a simplified and ultimately insufficient version of financial participation: work, earn, spend, occasionally worry, repeat. The wealthy were taught, or discovered independently through trial and error, a different set of instructions. Capture the available matches, deploy money into tax-advantaged structures, purchase diversified assets at low cost, automate consistently, minimize fees, and wait with genuine patience for the mathematics to do what the mathematics does. That is the gap. And it is not primarily an intelligence gap. It is not even primarily a discipline gap, though discipline matters. It is largely an information gap, a gap in financial literacy that was never systematically addressed by the institutions responsible for preparing people for the actual financial landscape they were going to inhabit as adults. So if you have $5,000 sitting in a checking account right now, or if you are working toward your first $5,000 with any level of intentionality, here is the single most important reframe available to you. Do not look at that number and feel underwhelmed by its size. Look at it and recognize that you are holding a seed, not a tree, not a forest, a seed. The seed does not need to be a forest by next spring. It needs the right soil, the right protection from unnecessary disruption, and enough uninterrupted time to do what seeds do when left alone in a favorable environment. Most Americans have been exposed, repeatedly, to the idea of getting rich quickly. The lottery mentality, the hot stock tip, the cryptocurrency narrative, the real estate empire assembled over a long weekend at someone's Marriott seminar. What almost no one has been taught with equal energy and equal conviction is how staggeringly, how almost incomprehensibly powerful it is to get rich quietly. Quiet wealth looks like an automatic transfer that executes on the 15th of every month, regardless of your emotional state that week. Quiet wealth looks like a Roth IRA with a balance that you do not mention at dinner parties because it does not feel dramatic enough to discuss yet. Quiet wealth looks like a 401k match captured on every single paycheck across 25 years, compounding inside an account you barely check. Quiet wealth looks like an HSA invested in index funds instead of perpetually drained to zero at the pharmacy. Quiet wealth looks like a portfolio with an expense ratio of 0.04% that saves tens of thousands of dollars in compounding drag over 3 decades, compared to the average actively managed fund. Quiet wealth looks, from the outside, like nothing is happening. And that is precisely the point. Because the people who look like nothing is happening are the same people who one day, without any single dramatic event having occurred, find themselves looking at an account balance that changed their entire set of life options. No viral moment, no secret strategy, no once-in-a-generation opportunity that they happen to be in the right place to catch. Just $5,000, deployed correctly, into the right container, at the right cost, with the right tax structure, on the right automated schedule, left completely undisturbed for long enough to become something that changes the trajectory of everything that comes after it. That is the whole thing. There is nothing hidden behind the next video, the next tip, or the next financial personality who discovered a strategy that everyone else mysteriously missed. The tools are sitting right there. They have been sitting there. The question is never whether the path exists. The question is whether you are willing to commit to something boring enough to actually work, and then stay committed to it long after it stops feeling like an act of courage and starts feeling like an ordinary Tuesday.